Should you add long maturity bonds into your portfolio now? Typically, longer maturity bonds have higher yields as compared to short maturity bonds. However, they are exposed to two risks most significantly. Number one, interest rate risk, and number two, inflation risk. In 2022, global central banks raised interest rates significantly to deal with high inflation, and therefore long bond investors actually bore the brunt of this process. We do see three things changing going forward, which could start making longer term bonds more attractive as compared to what they used to be. Number one, inflation coming down. RBI has a targeted inflation rate of 4% plus minus 2%. And we are now starting to see inflation in India come down due to lower oil prices on the back of global slowdown concerns, as well as lower vegetable prices due to government intervention. As a result of inflation coming down, you could actually see interest rates not being hiked anymore and RBI actually get into pause mode. Number two, earnings yield are less attractive as compared to bond yields. This is true both globally as well as in India. If you look at data as of 24th November 23, the 10-year GSEC is at about 7.27%, while the earnings yield on equities is at about 4.7%. Therefore, an equity investor is probably not getting compensated enough for the equity risk that he may be exposed to. It is therefore a good idea to look at both global bonds and Indian bonds relative to equities. Number three, higher for longer interest rates. One of the things that central banks are a little concerned about, both globally as well as in India, is cutting interest rates too quickly, because it could mean that inflation could come right back. And therefore, the commentary seems to indicate that interest rates may remain longer for higher periods of time, making coupons and interest very attractive as an option for investors until the point where they start cutting interest rates, maybe sometime in the second half of next year, where there will also be some capital appreciation for bond investors. Keeping all of these three factors in mind, it may be a good idea to gradually start adding long-term bonds into your fixed income portfolio.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of Basel and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory.